Let's get at a fundamental perspective on Street View. Devang Mehta, VP and Head Equities Sales at Anand Rathi joins us right now on the show. Good having you, Devang. Thanks so much for taking the time out. What's the view on cement now, Devang? By virtue of the expectations that there could be a CCI order, the penalty of 8%, highest ever in the CCI history, the stocks aren't showing that kind of a weakness.
Afternoon, Neeraj. Yeah, we do feel that the CCI order, which is impending today, almost 5% of the correction in these stocks have been factored in. What we feel currently is that the non-cement businesses of a lot of companies, which companies like JP Associates, Kesoram, all these companies will be impacted more. Pure cement plays, if there are some companies, Chettinad Cement, Madras Cement, all this will be vulnerable to this news. Again, if we talk about the large caps like ACC, Ambuja, Ultratech, around 10% correction in these stocks will be buyers because we know that mostly all these companies will have headroom to take this matter forward with the higher authorities or the appellate tribunal. So probably we feel that this news won't make much of an impact if at all the penalty is somewhere between the 3% to 5%.
Devang, what's your view on Edicom with the FCCB approval or rather the fundraising? Does it seem like, well, in the near term, there could be some debt repayment, but the long-term issues with the fundamentals of the company would still persist? And what we're seeing today is just a knee-jerk reaction on the stock.
Exactly. This space was enjoying a lot of valuation premium initially around 2.5 years back. But due to certain corporate governance issues and also because of the high debt on a lot of such companies, the space is not enjoying that sort of a comfort zone with the investors. So probably if somebody has Edicomp, we would suggest a hold. At this valuations, doesn't seem that one should exit. But I wouldn't suggest any fresh buy in Edicomp after this run-up.
Devang, the other thing is, if you look at the market since the last 4 or 5 months, the beaten down spaces like infrastructure, for example, have given a 15-20% return, and all the consumption slash FMCG, for example, stocks have come off. What do you do in a scenario like this at the current point of time? Would you still go ahead and buy infrastructure, capital goods, which are not at the lows but still in distress, or would you go in for the earnings theme and therefore go in for the consumption names?
See how much cliche it may sound, but I think probably market is going to give premium to stocks which are continuously showing excellent earnings, very good business models, robust ROEs. Probably I think companies like Castrol, companies like Aditya Birla Nuvo, which are currently doing extremely well. If I can talk about Castrol, the company currently has excellent ROEs. The company's the crude coming down will also have a great impact on its bottom line. So these companies would probably enjoy valuation premium, and we would rather be more stock specific rather than being sector specific. And in fact, infrastructure rather than infrastructure, we would prefer something in the infrastructure finance space like an REC or a PFC, IDFC, which would reap the benefits of infrastructure doing well before the infrastructure stocks do well.
Devin, what about the entire aviation pack? Because there is, a comment coming in from the aviation minister saying that they are going to look at opening up FDI in the sector soon. Is that a good opportunity to buy into any of the aviation stocks, or because of the fundamental concerns, you'd still rate it as an avoid?
We have always maintained that the aviation sector would be best avoided. Across the world, we have never seen people making good money in aviation stocks, and the same applies for India as well. And plus about 50% of their operating costs come in from ATF, which is also a huge cost, and also no competitive power with the industry. Only FDI in aviation is going to be a little bit of trigger. There will be surely trading bounces in the stocks, so traders could very well take their opportunities following appropriate stop losses. But for investors who are hardcore investors for longer term, we wouldn't prefer aviation space when the market offers a lot of attractive themes and valuations in other stocks.
You mentioned Castrol, Devang. If you had to pick one large cap, what would it be?
We would also prefer a stock like Aditya Birla Nuvo. As I said, the company is a diversified group. The management integrity and the quality of management is unquestionable. The Aditya Birla Group, headed by Kumar Mangalam Birla. Also, we could also see that the company is a holding company for a lot of businesses like insurance, Birla Sun Life Insurance or Idea Cellular. Also, the company diversifying into retail by taking an arm of Pantaloon is also going to do extremely well. The brands that the company owns under the Madura codes like Van Heusen, Louis Philippe, Peter England, the company is slated to do extremely well, and I don't think that the market is offering it an appropriate valuation. I think the company deserves a strong re-rating, and somebody who is having a one-year horizon can easily make 35-40% in Aditya Birla Nuvo.